Hey guys, I'm here today with Sean Gleason from the Nassau office of New York Life. Sean is an expert in life insurance, disability, long-term care, and we just had a couple questions for him. First one, which is pretty important. Sean, do you think it's important for people when they're buying a home to get life insurance?
Yeah, it's a non-negotiable. You buy a home, you're reliant on two incomes. Typically it's a two-income household, husband and wife or whatever spousal arrangement. And if one of those incomes stops, the mortgage still needs to get paid. And life insurance can be that immediate cash buffer that allows that surviving spouse to not have to uproot their life, be able to pay that mortgage and still live in the place that they want to live.
Terrific, that's great. And we always stress it every time. When we take an actual loan application, one of the questions are under assets, do you have life insurance? So we don't force anybody to get it, but we always recommend it's a good thing to have. God forbid something should happen. Now, let's say you have two spouses and they buy a house together, they're both working, and nobody passes away, but something happens. Somebody gets sick or they get disabled in some way and they're not able to work and their income is going to drop drastically. What do you recommend in those cases?
Yeah, well, first and foremost, understanding your workplace benefits is the first priority. Do you have some form of disability replacement at work? And a lot of companies do offer that. And then once you have that, do you understand how much you're getting, right? Because you have to reassess your bills, your budget strategy. And if it's not going to be able to replace that income, we want to get as much of it as possible. And if the workplace isn't providing that, you can go ahead and get your own individual policy. Individual disability insurance is a way to replace basically the maximum amount of allowable income to help you basically pay off those debts while you're going through this traumatic experience of disability until you're able to get back to work. And it's a way to do it.
So there's short-term and long-term disability?
Well, individual disability insurance is a long-term disability insurance strategy, not a short-term disability.
Okay.
So that will be something where you have an elimination period that's kind of preordained in when you sign up for the policy. And once you've satisfied that elimination period, you'd be able to take in that money from the disability insurance policy that you have for whatever duration you set it for, because these are some of the particulars you select when you apply.
Okay, great. And another type of insurance that I see a lot, and unfortunately as you get older, that's when most people are going to come across a need for it, is long-term care insurance. What is that? Because a lot of people have no idea what it is when I even bring it up.
Yeah, that's a good point. People get conflicted a lot with health insurance. They think maybe a health insurance would cover long-term care expenses, and they do not, right? An extended health event, I always say, is the #1 retirement killer, right? You have to tap into all the resources you've worked your entire life for to be able to pay for care, whether that's in an assisted living facility or at home where most people want their care. And long-term care insurance can be utilized to be able to private pay for the care that you want and deserve to live with dignity when you're going through these events, whether it's survivable or not, because we kind of see both sides of that. It also can be used as a buffer asset. A lot of people don't realize, like, they think about Medicaid as a way of being able to pay for long-term care, but maybe they're not eligible right away. They need to speak to an estate attorney about hiding their assets or whatever the case may be to make them eligible. But in the interim, having a long-term care insurance policy is a way to satisfy the care that you want while waiting for eligibility for Medicaid that will then take over if that claim goes on further.
So if you activate a long-term care policy, the fact that you own a house or have other assets, that's not going to restrict you at all, right? When you can use that money for whatever that long-term care need is, like you said, going into a nursing home, assisted living, or having somebody come to the house. And like you said, that's probably the most popular way. People want to be able to age in place. They want to stay in their homes.
Yes. Yeah, it's a reimbursement strategy. So you're private paying for the care that you want with maybe the trusted company that you want. I mean, there are a lot of them out there. And we reimburse you for that care up to the limits that the policy stipulates, which again are done during product design and over the year, being able to evolve it and have it grow with the changing needs of care. Like, it goes up in cost.
Right.
So,
I mean, I could tell you that I've actually done reverse mortgages for people, and the way they've funded their payments on the long-term care has been by getting that monthly income from the reverse mortgage. So they've really played nicely, hand in hand, allowing people, again, the goal is to be able to stay in the house. And if you need that aid to come in or whatever the case is, you can do that by using both of these strategies. What's the biggest, the toughest thing, I should say, when it comes to life insurance, as far as having that conversation, especially with somebody that they may be in their 30s, young couple, they just bought their first house, maybe they got a little kid. What's the toughest thing? Because nobody wants to talk about their mortality. So what are the kind of things that you go over with them?
Yeah, I mean, young couples think they're invincible. It's just kind of the natural instinct. I probably thought the same way when I was 30 as well. But you have to really stress the importance of you're responsible for the people that you love, whether it's your wife, your children. They are dependent on you and your ability to earn income, to feed them, house them, take them to the doctor, take them to soccer practice, all the above. And it's stated for me as it's a non-negotiable. Like if you're married, you have an obligation to your wife and kids to be able to protect them for a worst case scenario. Now, in life insurance in particular, more people would rather own life insurance than kind of rent it. That's kind of what term insurance is. That's what I get all the time. People want to own it. I want my money to go towards something that I can take out of or builds equity, much like a home, like renting an apartment versus owning a home.
Right.
It's very similar philosophy. So trying to find that right tailored approach, because you can have a multiple policy strategy that takes into account all the variances of life insurance to create the perfect portfolio. That's the way I kind of approach it with people. And usually you get a lot of buy-in going down that route when they realize how much coverage they should have.
Right. And how do you even figure out how much coverage somebody should have? Like, I would assume everybody's different depending on the situation. What are their assets, how many kids they have, whatever the case is. So how do you even come up with a strategy for something?
That's a great question. We have our process at New York Life walks people through not only the different types of insurance, but the different types of things you need to focus on when you're trying to calculate insurance need. And a lot of those numbers are client supplied, right? How much is your mortgage? That's a pretty black and white number, right? How much income do you earn? How much does 6 months of bills cost you? Like all of these things add up to an aggregate number. And then it's figuring out how to tailor it where you can adjust it over the years, whether the different types of insurance, the different durations of those insurance, so that your portfolio can stay fluid while you're going through life, because your lifestyle now is vastly different than it's going to be 20 years from now. And I think that's a trap people fall into, is
Right.
They get that one policy that's static and great, set it and forget it, but it's not evolving with how your needs change.
Okay, and I'm assuming it's easier and probably less expensive to get it when you're younger than when you're older, when the ailments all start and everything else starts coming around. Unfortunately, we all start to hit that wall. Is that the case still, where you can get a less expensive policy, pay less and get more coverage when you're younger?
Get your life insurance when you're young. Bottom line, that is the top priority that you should do. Whether it's permanent or term, right? Term offers typically a lot of conversion options, things that you can upgrade when your income is different. Okay. So even if you're 21 and working at a restaurant, you could support $20, $30 a month to get a term policy, knowing that you might not necessarily need the coverage, but the intent is to lock in insurability while you are healthy, because there are things that happen suddenly that you cannot overcome. And insurance companies are a bit unforgiving when it comes to that. Like if you have, they're assessing you as a risk. Right. And if there are medical reasons why you can't get approved, they won't approve you. And there's really nothing you can do about that at that time.
So I work with a lot of different groups, organizations, or even small business owners. Is there a benefit to a group coming in and setting up some kind of plan as opposed to the individual? Like, will that group, if I have an employer and want to bring it in for his company, for his employees, is there a benefit to them to do this? Because I would think it's a nice way to retain their employees by offering it as some type of benefit to them.
Yeah, well, it depends on how the business is structured too, right? There's different levels and tiers of benefits. The most common that people are used to is what would be formed as group term or group disability, something that is typically employer paid. Sometimes it's co-paid a little bit, where the employee will pay a very minimal cost for a specific amount of coverage, both on the disability and term side. There are other upgradable, unique benefits that can get added to an existing platform where employees can opt in for permanent life insurance, something that is cash value growing, something that's not only guaranteed to be issued, which is great for employees that might have medical afflictions, but is portable. It's something that you can take with you when you retire, and that's an attractive benefit to keep people there, because that's what business owners want to do: recruit, retain, and reward their talent. And there's a variety of different ways to do it, but the important thing is you do it because that's what your employees want.
Right, which is, you know, that's great, and very similar to what we do. We have mortgage programs for groups, and we put it out there as an employee benefit. Their employees may save some money on the closing costs, but they also have dedicated loan officers to work on that particular account, that particular company or group, and it makes things flow a lot easier for their employees. And again, it's a benefit that they're offering to retain or recruit. We offer these things, you know. So okay, so it's the same exact thing with the
same concept,
with the insurance as well. All right, I don't really have any other questions. Anything you want to?
Yeah, I mean, one thing I would want to hit on is life insurance as a mortgage acceleration strategy. It's one thing we didn't really talk about.
Sure.
So a common practice, and you're in this field, is people will make 13 months of payments in a 12-month year to help pay off their principal a lot faster, right? And you're still going to pay all of that interest to the mortgage lender at the end of the day, right? You have to pay that over the 30-year term of that. So what some people will do is they will take that excess payment, and rather than make the extra payment each year, they will use that to buy permanent life insurance, something that builds cash value over the duration, and then say in year 15, year 20, they can borrow against that life insurance policy, pay off the mortgage, foregoing a lot of the interest they would have paid to the lender, and then be able to pay the interest back on the loan to their life insurance policy, which is typically lower than the interest rates, with interest rates being where they are. And it is variable based on the interest rate environment that we're in, but then they get to pay themselves back.
I was going to say, you're taking a loan from your own policy, and then you're paying yourself back.
Correct.
Right?
You're leveraging it that way. So that could be a way to accelerate your mortgage by 10 years. I know most circumstances, if someone's paying an extra payment per year, they're going to, cut off 6 years or so on their mortgage. This could be a way to do it even faster than that.
And God forbid something does happen, a couple takes life insurance policies, and one does pass away. The money that they get from that policy, do they have to pay tax on that money?
No, it is completely tax-free.
That's great.
And that's huge. And a lot of times with a death claim, we want to make sure we're sitting with the other spouse and strategizing. It's one thing to just take a big lump sum check in. It's another thing to have a really good strategy behind it to make sure that their lifestyle can be maintained and not exhausted. Because sometimes the best strategy isn't paying off the mortgage in its entirety. Maybe it's creating income or investing a little bit or whatever the case may be.
And they can pick whichever option works best for them.
Exactly.
They're not forced to do one thing or another.
Nope.
Okay, that's great. All right, well, again, how do people get in touch with you?
Oh, so I can be reached, you can Google me, Sean Gleason at New York Life, the first thing that comes up. I can be reached at my phone number, 516-330-9639. Anytime you want to reach out to me, I'm here to help and answer questions. I love educating and I love what I do.
Great, and we're going to have all of Sean's contact information as well as mine, on the screen below. So if anybody has any questions regarding mortgages or insurance, give us a ring and we'll be happy to help you. Thank you very much.
Thanks.